The biggest lie in modern money is that saving is always safe. I have watched people do the responsible thing for years and still fall behind. They worked, delayed pleasure, avoided risk, and trusted the bank. Then they woke up and found that the price of the life they wanted had run away from them. That is not bad luck. That is the system working exactly as it was built to work. If you want to keep hearing the patterns I study before they hit most people in the face, stay close to this channel, because this one changes how you see every paycheck, every house price, and every market rally. I am not talking about a small mistake in personal finance. I am talking about a quiet transfer of wealth that has been happening in plain sight. Most people only notice it when groceries jump, rent jumps, and their savings somehow feel smaller even when the number in the account looks bigger. By then, the damage is already well underway. When I say the saver lost and the asset owner won, I am not trying to be dramatic. I am describing a pattern I have seen through debt cycles, inflation cycles, and policy cycles for decades. A saver, in the simple sense, is someone who stores most of his life energy in cash or cash-like deposits. An asset owner is someone who owns claims on businesses, land, commodities, useful property, or other things that can rise when money loses value. Those two people can be equally disciplined, equally smart, and equally hardworking, yet end up in very different places. Most people explain this the wrong way. They say rich people just got lucky, or markets only went up because traders were reckless, or home prices rose because everyone suddenly wanted a bigger kitchen. There is some truth in those stories, but not enough truth to guide a life. The deeper cause sits under all of it. It sits inside the way money is created, the way debt grows, and the way governments respond when the debt load gets too heavy to handle honestly. I have spent much of my life studying long-term debt cycles. A debt cycle is what happens when borrowing rises for years, then decades, until the system becomes too burdened to grow normally. When that happens, policymakers face hard choices. They can let the pain hit all at once through defaults, bankruptcies, unemployment, and falling asset prices, or they can print money, cut rates, support credit, and stretch the pain over time. Most of the time, they choose the second path because it looks less brutal in the short run. That choice matters more than most people realize. When central banks cut interest rates, they reduce the reward for holding cash. Interest is the payment you earn for waiting. If that payment is tiny while inflation is high, your real return turns negative. Real return simply means what is left after inflation. If your account pays 1% and your cost of living rises 5%, you did not gain 1%, you lost 4% of buying power. That is why I said years ago that saving in cash was one of the worst things most people could do. In 2018, the average savings account rate was around 0.09%, while consumer inflation was about 2.7%. That gap may look small on paper, but over time it acts like a slow leak in a tire. You do not hear an explosion. You just keep losing pressure until the vehicle stops carrying you where you thought it would. That is how cash hurts people. It hurts quietly, which is why it is so dangerous. And the quiet part fools people. If I lose money in stocks, I feel it right away because the screen turns red. If I lose money in cash, the screen stays calm. The bank balance still says $100,000, so my brain tells me I am safe. But safety is not the number. Safety is what the number can buy. If the price of a home, education, healthcare, energy, and food keeps rising faster than the yield on my savings, then my calm-looking account is not protecting me. It is simply hiding the loss. The reason this gets so powerful during a debt-heavy period is that cash is not separate from policy. It sits right in the middle of policy. In early 2020, when the pandemic shock hit, the Federal Reserve expanded its balance sheet from a little over $4 trillion to nearly $9 trillion by 2022. The money supply, called M2, which is a broad measure of cash and near cash in the system, jumped from roughly $15.4 trillion in early 2020 to about $21.7 trillion around its peak in 2022. That is an enormous change in a very short time. When a lot more money chases a limited set of assets, prices do not stay still. They rise, stocks rise, houses rise, land rises, fine art rises, private business values rise. Even mediocre assets can rise for a while if enough liquidity enters the system. Liquidity is just a simple word for how much money and credit are available and how easy it is to use them. When liquidity floods the system, it does not spread evenly. It rushes first toward financial assets and scarce assets because those are the easiest places for large amounts of money to go. This is where the saver starts losing badly. In July of 2022, the FDIC national rate for savings deposits was about 0.10%. At almost the same time, U.S. inflation hit 9.1% in June 2022, the highest annual reading since 1981. Think about that gap in human terms. A family that felt proud for keeping cash in the bank was earning almost nothing, while the cost of living was jumping at one of the fastest rates in 40 years. By December 2022, the national savings rate had risen only to about 0.30%. That was still nowhere close to repairing the damage. Now compare that with what happened to assets. The S&P 500 total return, which includes dividends, rose about 18.4% in 2020 and another 28.7% in 2021. Yes, it fell about 18.1% in 2022 when rates rose, but then it came back with roughly 26.3% in 2023 and about 25.0% in 2024. That is not a smooth line, it is volatile. But over the full stretch, the owner of productive businesses was playing a different game from the saver. The saver was trying not to move. The asset owner was riding the repricing of the world. Housing told the same story in slower motion. From early 2020 to late 2024, U.S. home prices rose by roughly 50% on the national Case-Shiller measure. That means the person who already owned a home often saw a huge lift in net worth without building a new room or learning a new skill. Meanwhile, the person who was carefully saving for a down payment often watched the goalposts move faster than his monthly deposits. He did the math, stayed disciplined, and still felt punished. That feeling was real because in many cases he was being punished by a structure, not by his own laziness. If this pattern has ever made you feel like you were running harder just to stand still, ask yourself one honest question. Was your money working inside the system, or were you standing outside it, holding the one thing the system could cheaply create more of? That question matters more than almost any hot stock tip. I want you to sit with it, because once you see the answer, you stop judging yourself so harshly for what was often a structural trap, and you start making very different decisions. I do not say that to excuse bad behavior. Chasing garbage assets with borrowed money is still foolish. Buying things you do not understand is still dangerous. But I am saying something simpler and more uncomfortable. In a world where policymakers respond to debt by making money cheaper and more abundant, the ownership of productive and scarce things gains an advantage over the ownership of idle money. That is the core mechanism. It is not glamorous, it is not emotional, it is just cause and effect. The same logic shows up in how institutions behave. Companies themselves understand the game. In 2021, S&P 500 companies spent about $881.7 billion buying back their own shares. A buyback means a company uses cash to buy its own stock, which reduces the number of shares and can support the stock price. In 2022, those buybacks rose to about $922.7 billion, a record. So while many ordinary people were sitting in low-yield deposits, big corporations were actively using balance sheets to support asset values. That is not an accident, that is informed behavior. I also watch who owns what. The top 10% of wealth holders in the United States own the vast majority of stocks, around the high 80% range by many estimates. That means when financial assets surge, the gains are not spread evenly through society. The bottom half of households own far less in stocks than people think. Many hold some through retirement plans, but not enough to offset the rising cost of housing, education, and daily life. So the same policy that stabilizes the system can also widen the gap inside the system. That is one reason the anger feels so personal now. I understand why people call that unfair. In many ways, it is unfair, but markets do not pay me for outrage. They pay me for seeing the machine clearly. And when I look at the machine, I see debt, policy, and asset ownership feeding each other. I see governments that cannot tolerate high borrowing costs forever. I see central banks that move between tightening and easing depending on what breaks. And I see that over long stretches, the holder of cash tends to finance the adjustment while the owner of assets tends to benefit from it. At this point, a smart person usually raises the obvious objection. If assets always win, then why not put everything in assets and forget cash forever? That is not my view, and it never has been. Cash has an important role. Cash gives me optionality. Optionality just means freedom to act. It lets me pay my bills, survive a shock, and buy opportunities when others are forced to sell. Without some cash, I can become fragile, and fragility is expensive. That is also why I later said that cash was no longer trash in the same way once short-term rates rose. I changed my view because conditions changed. By late 2022, cash yields were much better than they had been before. I am not ideological about assets or cash. I care about real returns, relative value, and risk. If short-term treasury bills yield 5% and many assets are priced for perfection, then cash can be a smart holding for a period. But that does not cancel the larger warning. It proves it. The larger warning is that most people think of cash as wealth, when cash is often only temporary purchasing power. It is a parking place, not always a destination. When debt loads are huge and political pressure is intense, governments have strong reasons to keep nominal growth above the cost of debt. Nominal growth means growth measured in current dollars, not inflation-adjusted dollars. If prices and incomes rise in dollar terms while old debt stays fixed, the debt burden becomes easier to carry. That helps the debtor. It hurts the creditor. And the small saver is often an unintentional creditor. I saw versions of this long before the pandemic. I saw it in the inflationary 1970s when cash holders were hit hard in real terms. People remember high interest rates from the early 1980s, but they forget how much damage had already been done before those high rates finally arrived. Inflation had eaten into savings, bondholders got hurt, and owners of real assets or businesses with pricing power were in a much better place. Pricing power means the ability to charge more without losing too many customers. In inflationary times, that ability is gold. I also think it helps to step back even further. In 1971, the United States ended the direct link between the dollar and gold. That mattered because it made the system more fully credit-based. Credit is future spending pulled into the present through borrowing. Once money is less tied to a hard anchor and more tied to policy choices, the management of debt becomes even more central. That does not mean the system is fake. It means trust, policy, and incentives matter even more. And when too much debt builds up, the temptation to reduce its real burden through inflation becomes stronger. There is a term for this that sounds technical, but is easy to understand. It is called financial repression. Financial repression means policymakers keep returns on safe cash and bonds lower than inflation for a stretch of time. They may not say it that way on television. They usually talk about stability, employment, crisis support, or orderly markets, but the effect is the same. Savers earn less than the rise in prices, and debtors, including governments, get relief. It is a hidden transfer, and hidden transfers can last a long time because they do not trigger the same public outrage as an open tax hike. If you want to know why the saver lost, that is the sentence I would underline. The saver lost because the system often needs money to be cheap and debt to become easier to carry. The asset owner won because assets are where excess money, falling discount rates, and scarcity pressure tend to show up. None of this means every asset is good. None of it means every rally is healthy. It means the river has a direction. If I keep swimming against that direction with all my wealth in cash, I should not be surprised when I end up exhausted and behind. And if your own plan still depends on a bank account to carry your future for 10 or 20 years, I would urge you to ask a harder question. Are you saving money, or are you saving the right to buy less later? That is not a clever line. It is the central issue. I have watched too many careful people confuse nominal safety with real safety. They protected themselves from volatility and walked straight into erosion. There is also a political layer that people resist because it sounds cynical, even though it is mostly arithmetic. Governments with very large debts do not have many painless choices. They can cut spending deeply, raise taxes aggressively, default outright, or reduce the debt burden over time through a mix of inflation, low real rates, and growth. The last option is usually the most politically acceptable. It spreads the pain, hides part of it, and keeps the system moving, but the cost does not vanish. It lands on the holders of money and fixed income claims. That is why I pay so much attention to incentives. I do not need a conspiracy to explain what is happening. I only need to ask what each player is rewarded to do. Politicians are rewarded for avoiding visible pain before the next election. Central bankers are rewarded for preventing collapses and preserving function. Corporations are rewarded for maximizing share value. Wealthy investors are rewarded for owning scarce and productive things. The ordinary saver is often rewarded only with a statement that looks stable. Once I line up the incentives, the outcome stops being mysterious. There is a global angle too. The United States issues the world's main reserve currency, which gives it enormous advantages, but it also creates pressures. When the Treasury needs to issue large amounts of debt year after year, the system needs buyers. If domestic and foreign buyers demand much higher yields, the interest burden rises fast. If yields stay too high for too long, something else tends to break. So over time, there is a structural pull toward lower real rates than many people assume. I do not treat that as a short-term trading call. I treat it as a long-term background force. I also watch what central banks outside the United States do. In recent years, many have been buying gold at a strong pace. Gold does not produce cash flow, so some people dismiss it. But central banks do not buy gold because it is exciting. They buy it because it is a reserve asset with no one else's promise attached to it. That tells me something important. Even institutions that operate inside the credit system want some protection from the credit system. When I see that behavior, I pay attention. None of this means the dollar is about to vanish or that civilization is ending next Tuesday. I am not interested in cheap fear. I am interested in balance. A debt-based system can go on for a long time. It can adapt, it can recover, it can innovate, but it also follows patterns. One of those patterns is that cash looks safest right before it becomes least effective as a long-term store of buying power. Another is that productive assets often look dangerous right before policy turns in a way that helps them again. So what could happen next? One path is a softer version of the same world. Growth cools, inflation settles above the old normal, and central banks gradually lean easier whenever markets or employment weaken too much. In that world, cash has a role, but diversified asset owners still do better over time because the value of scarce and productive things keeps adjusting upward. It is not a straight line. It never is, but the pressure remains. A second path is a sharper downturn. In that case, assets could fall first and cash could briefly feel like the winner. I want to be honest about that. Recessions can punish stocks, real estate, and private assets all at once, especially if people use too much leverage. Leverage means borrowed money. Borrowed money makes gains feel easy on the way up and pain feel unbearable on the way down. In that environment, the person with liquidity and patience can buy well. The person who confused leverage with genius usually learns a hard lesson. A third path is the one I worry about over the very long run. Debt keeps rising faster than income, political conflict gets worse, and confidence in financial promises becomes more fragile. In that world, policy may keep trying to balance inflation, growth, and debt service, but the balancing gets harder. Real assets, globally diversified assets, and stores of value outside any one promise may matter more. Cash would still be useful for short-term needs, but trusting it as the core of long-term wealth would become even riskier. If you want more thinking like this, not about noise, but about the forces underneath noise, keep this work close. Markets change costumes all the time, but the incentives under them move much more slowly. I have learned that the person who sees the cycle clearly does not need to predict every headline. He only needs to know which side of the structural pressure he is standing on. That alone can change years of outcomes. So what do I do with this insight in practical terms? First, I keep enough cash to survive and to have choices. Emergency reserves matter. Dry powder matters. The freedom to act when others panic matters. But I do not confuse liquidity with long-term wealth. I treat cash like oxygen and mobility, not like the final form of savings. It is essential in the right amount and dangerous in the wrong amount. Second, I spread my money across assets that respond differently to different environments. I want some exposure to productive businesses. I want some protection against inflation. I want some balance in case growth slows or markets crack. Different people use different tools for that. Some use broad stock funds, some use bonds, some use real estate, some use gold, some use inflation-linked bonds. The exact mix depends on the person, but the principle is simple. I do not want all my future tied to one outcome. Third, I think globally when I can. Concentrating all of my wealth in one country, one currency, or one policy regime can feel comfortable because it is familiar. Familiarity is not the same as safety. Countries go through cycles too. Policy mistakes happen. Political swings happen. Currency values change. I sleep better when I know I am not making one government, one central bank, and one asset class responsible for my whole future. Fourth, I avoid the trap of measuring success only in nominal dollars. Nominal just means the face value, the printed number. A person can earn more dollars and still be getting poorer in real life. I care about what my wealth can buy, the resilience it gives me, and how it behaves across changing conditions. That shift in measurement sounds small, but it changes almost everything. It changes how I view cash yields, how I judge risk, and how I define progress. I also think this is one reason so many younger people feel angry, even if they cannot always explain it cleanly. They were told to study, work, save, and be patient. Many did exactly that. Then they saw home prices leap, asset owners get richer, and wages struggle to keep up. Median weekly earnings rose over the past several years, but not nearly as fast as many key assets did. So they felt like the old map no longer matched the terrain. In many places, they were right. I do not say that to create resentment between classes. Resentment is easy and useless. I say it because clarity is kinder than confusion. Once I understand that the game rewards ownership differently from saving, I can stop relying on outdated advice. I can stop mistaking effort for strategy. I can start building around reality instead of nostalgia. That does not guarantee comfort, but it gives me a better chance to protect my buying power, and buying power is what I actually live on. So when you hear me warn that the saver lost and the asset owner won, hear the full message, not the slogan. I am not saying never hold cash. I am not saying buy every dip or worship risk. I am saying that in a debt-heavy world, money itself is often the asset policy makers are most willing to dilute. If I understand that, I stop asking only how much I have. I start asking what I own, what it can become, and how it behaves when the cycle turns. That is the shift I want to leave with you. I want you to see the bank balance, the house price, the market chart, and the inflation print as parts of one connected system. I want you to notice that what feels safe in the short run can be dangerous in the long run. I want you to understand that patience matters, but patience without the right vehicle can turn into slow surrender. The world does not only reward effort, it rewards position. I have watched this pattern repeat in different forms. under different leaders, through different crises, with different words used to explain it. The details always change. The mechanism rarely does. When debt gets too large, money gets pressured. When money gets pressured, asset prices adjust. When asset prices adjust, owners get relief and savers get tested. That is why the gap feels so persistent. It is not only social, it is monetary. And in the end, the lesson is painfully simple. If your money cannot keep its buying power, you're not saving wealth. You're watching it evaporate in slow motion.